Hi, folks. This is Sean Hyman from Chart of the Day, and I just want to talk to you about the chaotic non-farm payrolls report and the 5 hours afterwards. And we'll be looking at euro dollar, and the payrolls report came out. Basically, the U.S. employment report minus farm payrolls is was looking at basically no change. I saw some reports and economists and analysts that had were banking on negative 3,000. And then I saw some that were flat, zero expected. So in other words, it was basically expectations were for basically roughly no loss and roughly no gain, um, and give or take 3,000. And the jobs report came in negative 85,000. So there was a major loss of jobs in the U.S., far worse than expected, and the dollar just got crushed by it initially and headed upward. And here's why I don't trade uh, news events, employment reports, and that sort of thing. I do watch big macro trends and fundamentals. I do trade big macro trends and fundamentals, but I do not trade fundamental announcements. In other words, fundamental trading really is not trading a news event. That's really just a momentum or breakout type of trading. But to me, it's a lot more of a gamble because sometimes when a dollar report comes out good, it'll rally. Sometimes when a dollar report comes out bad, it'll tank. And in this instance, okay, the euro dollar starts heading upward, right? And people hop in at various points along the way. And of course, there will be a lot of people that will hop on once they see this thing start shooting up a pretty good bit. And so it takes off and they start getting a decent gain. If you go from the lowest low to the highest high, it was a 150 pip run just within, whatever, 20 or 30 minutes. Then it reverses, has a shooting star, and starts heading downward. And it takes back 115 of those pips. Granted, most people, I'm sure, didn't get in on the lowest of low, so where most people would have got into it, they would have gone all the way up and all the way down, and it take back 100% or most all of 100% of their profits, and even ones that got in higher, it put them in the negative. Scared the bejeebies out of them on the way down because that was fairly fast as well and steady. And so I'm sure many traders scrambled out of their long positions and either got scared to death, didn't make any money, or lost a little bit, only to see it reverse again and head back up 139 pips and head higher. And so it's all this knee jerk, this serious back and forth action, a huge gain, then almost the whole gain completely lost. And believe me, I've seen plenty of times where it gained like this and reversed and kept going, and the reversal was a bigger move than the original gain. But this one reversed most of the gain and then came back up and went another 139 pips from its low to its high, and then settled in. After 12 noon Eastern Standard Time, most of the big traders pack up for the day and for the week, and they're gone. And so even though the market will close, much later around 4 p.m. Eastern Standard Time, really your big institutions are gone by noon Eastern Standard Time. So that's what really makes the market kind of die off and the momentum go. I'll also point out to you that usually the first initial reaction of an employment report is usually retail driven, and that's because big institutions actually read the reports, actually dig into them, pick them apart. They'll look at other things like average hourly earnings, average work week worked, just a whole bunch of other facets that your retail investor doesn't look at. They'll look at the revisions from last month, which generally your retail investor doesn't look at, see the report on, or even usually care about. So things like that. So a lot of times your initial reaction is retail oriented. Your reversal many times is institutionally oriented. So there's a huge chance that even though this rallied back up later on, that we could see things fall over and head lower going into next week. Also, you've got a 5 waves down and then an A, B, C correction out of that. So there's a good chance that we could start another down wave. That's Elliott wave talk, but what that means is there could be another down wave here. Now, with that said, I want to look at the bigger picture on the euro dollar, and that's the daily chart. and there's this bearish flag that has formed. It's a negative pattern, and the flagpole normally serves as the projection for if this pair were to break out and close below its flag. So picture a flag and flip it upside down, and that's your bear flag pattern. If and it's bear flag because it heads lower quite quickly and then consolidates. It's catching its breath before it gets ready to head down lower. This is how this typically unfolds. So statistically, it has a higher probability of heading lower and breaking lower than heading upward. If it breaks lower, it typically breaks lower and eventually hits a target that is the length pip-wise of this initial move projected from where it breaks out here. So we're talking that could take it down into 135, 136 level very, very easily. So that's going to be interesting to watch and see if that's the case. I actually figured that the NFP event would be probably the catalyst that would break it out of this sideways consolidation. I say sideways, it's slightly upward sloping consolidation here. Now, however, if my anticipation is wrong and it does not break downward, as I think it will, because I think this is an Elliott wave 1, 2, getting ready for a 3 down, then and it heads back up, then if it breaks and closes above here, that's where people would tend to want to get long and ride the bounce back up. You would want to take extreme caution and move your stops up if the break were to the upside, because most of the fierce momentum has been to the downside, and the long-term daily uptrend has been broken. So any upsides that could be enjoyed could have quick reversals downward. So when you get, if it were to break to the upside and you get up on your money a decent amount, it's usually good to start moving those stops up past break even initially just by a few pips. And as the pair moves on up, hop it on up 25 or 50 pips at a time while keeping your stop well away from where the market is. It always needs to have plenty of breathing room, but you also want to remove your risk to the trade, as quickly as possible as well, while giving it a practical amount to move around the market. So that's why usually, a pair needs to move a good at least 50 or 100 pips before you move your stop just a hair past break even, so that you still have plenty of room for the pair to move if it does move to the upside. Now, you would want to be just as diligent on your stops, of course, to the downside, but the statistical probability of a downside break is much greater because of the bear flag pattern, because of when you look at consolidation, statistically they break out in the direction they were heading in before they went into consolidation. So that direction was down and then consolidation. So the statistical likelihood of a downside breakout is huge. Now, since I run the Currency Cross Trader service, why do I look at the majors? We've had a stellar time this past month or two. We've had several winners in a row, and I think our fourth one's going to come up another winner as well. Why has that done so well recently? A lot of it has to do with me watching the majors and see how they respond. If this breaks back down lower, then there's going to be a lot of weight on the euro, and that would push down things like the euro yen, for instance. And so I expect that if that breaks that down, that would really hurt that cross a lot with all the euro selling. Now you say, well, if this broke down, why wouldn't you just hop on euro dollar as opposed to euro yen? The reason is because you get more directional moves typically out of the crosses. You get longer moves out of the crosses, so more pips potentially to be gained, and you have less whipsawing because you've pulled the dollar out of the equation. It's a lot of the dollar events that cause a lot of your whipsaws and a lot of your stop outs on a lot of your trades and that sort of thing. So when you pull the dollar activity out of it, which is one of your biggest, it really is your biggest mover of currencies, or dollar news, dollar events, and that sort of thing. When you can pull that out of there, really helps to heighten your chances of success in your trade. So you improve your chances of success, you improve the number of potential pips that you have that you can gain, yet you can still pull from what's happening in the majors. And believe me, there is no more major currency pair in the world than euro dollar. So when this breaks one way or the other, it tells you a whole lot about the money flows that are going on around the world, whether it's going more into the Eurozone or more into the U.S., depending upon which way this breaks. Well, if if it breaks lower, then I know that there's going to be a lot of euro selling broadly across many pairs, which would hurt, for instance, across like euro yen. So it would behoove me to be short the euro yen pair as that weight of euro selling comes across broadly against most all pairs, euro-based pairs, that is. So anyway, that is the chart of the day. Hope you'll follow us not only on that, but in the World Currency Watch articles, in the free e-letters that we have at the Sovereign Society, and in the subscription-based Currency Cross Trader as well. Thanks so much for watching. I appreciate it. Bye-bye.